Would you invest money in a company that had no plans to turn a profit? Because that's what Uber is asking you to do. Hey everyone, this is Kevin the Apptrepreneur, and money. Money is a really interesting concept when you stop and think about it. It's just paper. It's colored paper. Really, we throw paper away all the time. We wrap our food with it, throw it in the trash afterward. And yet money holds a lot of value for us. We want as much as we can to survive as long as we need to. And when people ask us to give this to them, whether it be on the street or on the stock market, we always ask, what's in it for me? Because it's valuable to us. And we want to make sure our money is being used properly. I think that's why a lot of people don't give homeless people money, because they just don't know what they're going to do with it. Yeah, they're saying they want money for food, but what's to say that you're not going to hand someone this $5 and they're going to take it and they're going to buy drugs with it? You don't want your money going towards that, so you don't do it. And yet Uber is asking for lots and lots of money, $10 billion in fact, and they claim it might not even go towards anything that will produce fruit. But before we get into any of that, let's have a word from our sponsors.
And today's video is sponsored by Maximo, the rideshare automation app that allows drivers to safely and easily accept ride requests for Uber, Lyft, and Postmates. Whether you drive for a single platform or multiple platforms, Maximo's custom settings can help you drive more efficient, less distracted, and help you maximize your earnings. It will automatically accept one trip, turn off the other apps, and when your trip is over, it will end it, open the other apps, and accept the next trip, all without you having to touch your phone. Use referral code APP60 and get your first month free when you subscribe to Maximo.
And here we have the mainstream Business Insider article. Uber's disclosure that it may never be profitable coincides with the return of a danger signal from the .com crash. According to this article, Uber filed to go public Thursday, dumping a 300-page prospectus on would-be investors about its sprawling $11.3 billion business. Bloomberg's Shira Ovaid described it as the most complex S1 I've ever read. Among the revelations contained in this tome were details of Uber's love-hate relationship with its former CEO Travis Kalanick, revelations about who will get rich when Uber joins Wall Street, which we will be talking about in a future date, insight on its battle to maintain drivers as contractors rather than employers, and information on its relationship with Google, which is, by the way, very shaky. But also within the pages of the prospectus was an acknowledgement that laypersons might find startling. Uber says it may never be profitable. Let's go over that again. Uber says it may never be profitable. Actually, what do they say exactly? Here's what they say in actuality in the quote. We expect our operating expenses to increase significantly in the foreseeable future, and we may not achieve profitability. Now, some of you might be looking at it and say, well, they said foreseeable future. They didn't say never. But foreseeable future, that can be a long time. I mean, here's the thing. Amazon said that they didn't see themselves being profitable in the foreseeable future, and it took them 20 years. Now, there is a difference between how Uber is wording this and how Amazon is wording it. When Amazon worded it, and they still word it in this to a certain extent this way, they word it as they are not concerned about profits right now. They are concerned about growth, which they have been for 20 years. They are concerned about investing in the future. That is a polite way to say, we have no way to make money, but we're going to put a positive spin so that you don't feel like you're getting gypped. Uber just outright says it. We expect our operating expenses to increase significantly in the foreseeable future, and we may not achieve profitability. That's not even like a deadline, like we may not achieve profitability anytime soon. That's just, we may not achieve profitability. Yeah. Said the ride-hailing company, which posted a $3 billion operating loss last year. Definitely something you want to hear from a company like that. The document goes on to list a litany of risk factors which are standard prior to IPOs. These include its huge spending on things like drivers. It's not that huge, trust me. Unproven revenue lines and the danger of unrealized cost savings from its Careem acquisition, as well as the fact that Uber Eats, Uber's food delivery business, makes a loss on some of its partnerships with big chains like McDonald's, which is funny because Uber Eats is actually one of the few things that's profitable in general. Now, it's funny that they mentioned the unrealized cost savings from its Careem acquisition, because I think, and you can't prove that, I can't prove this, so it's a suspicion. It's a theory that one of the reasons Uber dropped the 20% rates, which led to the protests and the strikes and the drivers really getting fed up more so than they were before, is because I think they wanted to buy Careem. And they wanted Careem to be there so that they could show to the investors, we're growing, we're investing, and yet here it is in the IPO filing. They don't know if that's actually going to work out for them. Wonderful. They just spent almost $6 billion on them. Quote, we will need to generate and sustain increased revenue levels and decrease proportionate expenses in future periods to achieve profitability in many of our largest markets, including in the United States. And even if we do, we may not be able to maintain or increase profitability, Uber said. Again, not something you want to hear from a company that posts a $3 billion operating loss, says they may not achieve profitability. They want $10 billion in an IPO. Like, why? Why? And now let's talk about this. A reminder of the .com crash, because this is what's going to turn the video from just a general look what Uber said to a more serious contemplation on where our market is right now. The acknowledgement is far from unusual in today's market for initial public offering. Lyft's S1 contained very similar language. Quote, we have a history of net losses and we may not be able to achieve or maintain profitability in the future. Yeah, I mean, I guess we could say Uber and Lyft said that they will be profitable. While Snap also said it may never achieve or maintain profitability when it went public in 2017, 2 years on, Snap is still loss-making. Yes, Snap is still a loss-making stock. In fact, here's the thing. Snap was one of those companies where it's like, they went to the market, they said, we're not going to be profitable, we have no intention of being profitable, and everyone said, hey, look at Snap, everyone's using it, it's got to be profitable at some point. Apparently not. In fact, let's just look at what Snap is actually doing on the market. Let's see if we can do that. Snap stock. Let's just look at that. It's at $11.97. Max, well, it started out at $22.53. It's down to $11.97. Not the worst, but certainly not a direction you want to be going. Investors may well ignore the disclosures because they are betting on future growth and future profits, which Uber's finances show are well within the company's ability to generate. Probably if they raised prices and figured out a sustainable business model, but they don't want to do that. They want to subsidize rides and all this other stuff. But the disclosure is also part of a pattern. More and more companies are going public without profits. According to research from the University of Florida, finance professor Jay Ritter illustrated well here in Recode, 81% of U.S. companies floated as loss-making entities last year. The graph below, produced by Ritter, shows the percentage of IPOs with negative earnings per share since 1980. And there's a chart for you just in case anyone wants to, if anyone's like a number thing. So the percentage of tech stocks, percentage of IPOs, so, there we go. For tech firms, it was even higher at 84%, driven largely by biotech companies raising money. In fact, the last time that a large percentage of tech firms were going public without making money was in 1999 and 2000, when 86% of the internet companies that turned to Wall Street were unprofitable. The turn of the millennium was, of course, the year the dot-com bubble burst, leading to the death of companies like Pets.com, Cosmo.com. I remember Cosmo, a grueling recession, and lost about 200,000 jobs in Silicon Valley. Uber is likely to be the biggest IPO of 2019, which forecasts pegging its value at about $100 billion. That being the case, it will probably serve as the yardstick against which to measure this year's expected IPO bonanza, in which firms such as Pinterest and Airbnb are also set to go public. It may also be the canary in the coal mine if things turn ugly. Well, we already see what's happening with the Lyft stock. It's not doing so hot, so who knows what's going to happen with this in the long term. Uber has been honest about its profit-making potential, but it need not look far for an example of success. Amazon was the prince of no profit when it arrived on Wall Street in 1997, with courts pointing out that it lost $2.8 billion over the first 17 quarters after its IPO. Now Amazon makes more than $3 billion a quarter, as much money as Uber lost all of last year. Yes, because Amazon does make a little bit of money this year, primarily due to their cloud computing service. If it wasn't for Amazon Web Clouds, Who knows where they'd be, though. So, anyway, yeah, Uber claims that they have no intention of making money. You know, that face pisses me off a little bit. Let's go to the chart instead. There we go. So, here's where I'm going to end on story time. I was talking to a friend years ago. I think this was 2011. And believe it or not, piracy was still kind of a big thing with movies and stuff, where, you know, the debate, like, you know, how many people are downloading movies illegally compared to how many people are buying them was a thing. And he, at one point, said, I think the future of movies is going to be giving them away, which was crazy to me. It's like, why on earth would you give it away? There's no financial incentive to make the movies in the first place. And yet, about 10 years later, almost, I think this is 8, we now live in a world where things are pretty much given away for free. Your Uber and Lyft rides, I mean, heck, they're dirt cheap. You're practically riding for free. Amazon, they sell the stuff at a loss and free shipping. Netflix, they spend $72 million on Bird Box or something crazy like that with Sandra Bullock dropping on Netflix one day, you know, as part of a package, practically for free. Spotify, yeah, everything you can listen to, touch of a button, $10 a month, it's really free. So we do seem to be in an age where everything is just being given away in the hopes of achieving sustainability. But there are warnings. When you don't make money, you can have huge problems. You can have cash deficits, run up a lot of debt, as most of these companies do, and unless you have investors who are patient, then, you know, you're going to fold fairly fast. And here's the thing, Uber and Lyft have had investors who want to hold for the long run. They do. But what happens when people don't want to pick up the bag anymore? They don't want to foot the bill. What happens then? It's going to be very interesting. Personally, I would not be interested in investing in a company that says they have no path to profitability. I will buy a share of Uber and Lyft stock as promised for the channel and investment purposes for content on this channel. But I won't be buying any more than one. Like just one. Unless it's dirt cheap, then we might do the lottery theory. I'll invest in companies that actually are proven and make money or have their sights set on making money. I mean, I might invest a little bit more in Airbnb, to be perfectly frank, because Airbnb seems like it has a path to profitability. But Uber and Lyft, yeah, after everything that's going on, and we're going to be looking at more of their IPO problems throughout the week, like, this is a toxic company. I think you should stay away from it. It's ironic because I think tomorrow I'm finally uploading that how to buy stock for Uber and Lyft. I have it edited and everything. It's ready to go. Just waiting for a slow news day. And it's like, I'm going to feel really, really odd about uploading that considering my stance on this. But, of course, I'm going to turn the question to you. What do you think of this information? Do you think, like, honestly, like, let's be serious. Do you think there is a way for Uber to be profitable? I would love to know. So, comment below, like, favorite, share, subscribe. If you enjoy my videos, consider becoming a Patreon member. It's totally optional, of course, but even as little as $1 a month goes a long way to helping the channel run smoothly. Also, if you want to save on gas, don't forget to check out the Get Upside app, link below. You will save a lot of gas. Gas prices on the rise. It's wonderful. And check out my Apptrepreneur vlogs channel. It's a new channel, you know, vlogs, dates, my movie collection, stuff like that. But there's new content every week. And if you want to chat with me or someone else, check out the Apptrepreneur Hangout on Facebook. You have to be approved to join, but we've been approving most people. And as always, flame responsibly. Have a good one.